The world is waking up to the urgency of climate change. Governments and corporations are setting ambitious targets to reduce greenhouse gas emissions. Amidst this global push for a sustainable future, a new market is emerging: carbon credits. Carbon credits represent a tangible way to measure and incentivize emissions reductions. They are quickly becoming a hotbed of investment activity, attracting both environmentally conscious investors and those seeking new avenues for financial growth. Recent years have witnessed an unprecedented surge in the carbon credit market. In 2023 alone, the cap-and-trade market, where government-mandated emissions allowances are traded, reached a staggering $948 billion. The voluntary carbon market, driven by corporate social responsibility and the pursuit of net zero goals, also witnessed significant growth, reaching approximately $4 billion. These figures underscore the increasing significance of carbon credits as a financial instrument and a crucial tool in the fight against climate change. This burgeoning market is fueled by the growing commitment of countries and companies worldwide to achieve net zero emissions. The landmark Paris Agreement, adopted in 2015, has galvanized global efforts to limit global warming to well below 2 degrees Celsius, preferably to 1.5 degrees Celsius compared to pre-industrial levels. To achieve this ambitious goal, businesses across industries are actively seeking ways to reduce their carbon footprint, and carbon credits offer a viable and potentially lucrative solution. Investing in carbon credits presents a unique opportunity to align financial interests with environmental responsibility. As the world transitions to a low-carbon economy, the demand for carbon credits is expected to skyrocket, potentially leading to significant returns for early investors. The rationale for investing in carbon credits extends beyond potential financial gains. It is deeply intertwined with the urgent need to address climate change and create a more sustainable future. One of the most compelling reasons to consider carbon credits is the potential for portfolio diversification. Traditional investment portfolios, often heavily weighted towards stocks and bonds, can be vulnerable to market fluctuations. Carbon credits as an emerging asset class offer a way to diversify holdings and potentially mitigate overall portfolio risk. As the carbon market matures and gains wider acceptance, its correlation with traditional asset classes is expected to remain low, making it an attractive option for investors seeking to spread their risk. Moreover, carbon credits offer a hedge against inflation. As governments implement stricter environmental regulations and carbon prices rise, the value of carbon credits is likely to increase. This inherent link to climate policy provides investors with a level of protection against inflationary pressures, making carbon credits an attractive option in an uncertain economic landscape. The potential for growth in the carbon market is immense. As emissions caps tighten and the demand for carbon offsets continues to rise, early investors stand to benefit significantly from the anticipated price appreciation of carbon credits. The carbon credit market, though rapidly growing, is still in its nascent stages, presenting both exciting opportunities and unique challenges for investors. Understanding the different types of carbon credits, key investment avenues, and potential risks is crucial for making informed decisions in this evolving landscape. There are two primary types of carbon credits: allowances and offsets. Allowances are issued by governments under cap-and-trade systems, granting companies the right to emit a certain amount of greenhouse gases. Offsets, on the other hand, are generated by projects that reduce or remove greenhouse gas emissions from the atmosphere. Investors seeking exposure to the carbon market have several options. Carbon stocks, representing companies directly involved in carbon reduction or credit verification, offer a direct investment route. Exchange-traded funds, or ETFs, focused on carbon credits provide a more diversified approach, tracking the performance of carbon credit indexes. Thorough due diligence is paramount when evaluating carbon credit investments. Investors must carefully assess the credibility of the underlying carbon offset projects, ensuring they meet stringent standards for additionality, permanence, and verifiability. Additionality ensures that the emissions reductions would not have occurred without the carbon credit project. Permanence guarantees that the carbon sequestered or avoided remains out of the atmosphere for a significant period. Verifiability ensures that the emissions reductions are accurately measured and independently verified. Investing in carbon credits requires a long-term perspective and an understanding of the complexities of the market. Carbon credits are not just financial instruments, they are powerful tools for driving real-world change. By providing a financial incentive for emissions reductions, carbon credit projects can have a tangible impact on climate change mitigation, biodiversity conservation, and sustainable development. Investing in carbon credits goes beyond seeking financial returns. It's about contributing to a more sustainable and equitable future for all. Carbon credit projects span a wide range of sectors, from renewable energy and forestry to sustainable agriculture and methane capture. These projects not only reduce greenhouse gas emissions, but also often bring significant social and economic benefits to local communities. For instance, reforestation projects can restore degraded land, enhance biodiversity, improve water quality, and create jobs in rural areas. Similarly, investments in clean cook stoves can improve indoor air quality, reduce deforestation, and empower women by freeing up their time from traditional cooking methods. The future of the carbon market appears promising. Governments worldwide are strengthening their climate policies, and corporate net zero commitments are on the rise. This growing demand for carbon credits is expected to drive market growth and create new investment opportunities. However, challenges remain, including the need for greater transparency, standardization, and market integrity. As the market matures, addressing these challenges will be crucial for ensuring the long-term viability and impact of carbon credits.